We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are down and actually reaching their lows of the session. S&P 500 futures now down 2/3%. NASDAQ futures down 0.8%, and Russell 2000 futures now off more than 1% on concern after Jay Powell used the word transitory, concern that the Fed won't be able to cut rates as much as the market had anticipated. There's still two rate cuts in the median dot plot, but maybe people don't take that as seriously. Jay Powell has often said you shouldn't. At the NASDAQ, you got Logistics Health ringing the opening bell. A new issue there. They've lost about 12% since they started trading in February. Down at the New York Stock Exchange, JP Morgan ringing the opening bell, looking at the wall there, and they have announced a new inverse VIX short-term futures ETN. In case you're wondering, an ETN is this ETN incorporated in the United States, and the fund seeks to provide exposure to the daily returns of the S&P 500 VIX short-term futures points change inverse daily index TR, which they refer to as an index. So that's not confusing at all, is it?
Federal, the cuts to federal budgets, which are impacting, private institutions. There's a lot of uncertainty there, and the soft indicators are reflecting that. But there's something else in the soft indicators that we're not talking about, and I do think it's really important. And this is the extreme partisanship that is impacting this country. And I think that is actually a bigger driver of some of these more sentiment-based indicators, which is why we've got a divergence between the actual data and the sentiment.
But hang on, you don't think that's going away, right? We're not going to get any less partisan in the United States of America, are we?
I actually hope we will.
We all hope we will, but do you actually think that's going to happen?
But at the moment, do you think we can get more? That is the baseline. So the fact is that the current indicators already reflect this high degree of negative sentiment and extreme sentiment. And the fact is that it's going to get better.
This issue is something you might remember John Lewinson over at Diameter. This is what he said it was the next big risk for him, that you have investors reading partisan data and making decisions off of it. It is not the underlying fact. It is how people feel.
Right. If you look at inflation expectations, Republicans think there's no problem. We won't have inflation. Democrats think it's going to go up like a hockey stick. If you look at growth expectations, Republicans think we're off to the races in a new golden era, and Democrats think we are headed for a recession.
You couldn't have said it any better than we can, which is this idea that this partisanship is driving sentiment, which is why we need to go back to the data. So all I'm saying is that when we look at our bull-bear indicator, Wall Street's very driven by that bearish indicator, which is in extreme territory as well. So as I said, 60% of people are in that bearish camp. So we think that there's a lot of opportunity for the average investor to start buying the average stock.
What would turn that around? How do you make that 60% of bears turn into that 60%?
I think it's just some of those, it's actually just the negative news being resolved and falling away.
Tariffs.
So the tariffs get incorporated. Last time we had tariffs, actually there wasn't such a big impact. It was more about the fear of the news and that initial fear, and then when we actually got to the eventuality of them, it wasn't so bad. So it's going to be that transition that we see. It'll be the transition once we see how private institutions accommodate some of these changes to foundations and other organizations step in. So I think we're kind of at that peak fear, and for us, that's why we think that the market's close to a bottom, and we think there's an opportunity.
Depending what you want to buy, right? Because I want to buy Harley Davidson. Those prices are up like 40% since 2018. Tariffs all around. Let me ask you what you would buy in this market, Katrina. Like if I take my Doge dividend and go to you and say, please invest this for me. You just said the average stock. What do you want to buy?
So when we talk about the average stock, we're talking about the fact that if we look at earnings expectations on a 2-year forward basis, all sectors are actually doing well, and it's a much broader market. So that's what we talk talk about the average stock doing well. So when we think about technology stocks, you want to just go a little further down the market cap spectrum than, say, the Mag 7 stocks and look at purchasing some of those names. So that's what we're talking. We just think there's a lot more opportunity in the broader market than there is in the Magnificent Seven.
Speaking of the broader market, you look at a day like today, and that bearish read is still out there, Matt. Almost every sector in the S&P 500, barring utilities, is negative today. And we saw good earnings news, frankly. And so you look at the sectors that have been doing the worst this year. Consumer discretionary by far has sold off. It's down 14%. A lot of that is Tesla, fine. But even beyond that...
This is year to date, by the way.
This is year to date.
Take a look at one day, and you're going to see a sea of red there. Only utilities is gaining. Thanks, Joe.
But even on the year-to-date basis, one question I have is consumer discretionary has sold off so much that do you believe we've bottomed enough to even buy parts of the market that people are afraid of, the consumer sector?
So the consumer sector and spending there is really driven by the job outlook and people's expectations for jobs and retention. And that has been one of the changes that we've seen, that people are a little more fearful. And the cure of that is just time and employers' communication and messaging. I think at the moment, employers are a little focused on handling the tariffs, and that's generating this uncertainty, leading to concerns about the job number. Once we get through that narrative, I think people are going to be very comfortable in their jobs. We've got low unemployment, and those two things are going to start driving consumer sales.
God,
and that's well, maybe your Harley may not be cheaper.
I appreciate that that view, right? And that's what we all want. I don't think people who are bearish want the economy to be bad and want stocks to go down. They would prefer that the tariffs work in their intended way, and that the golden era drives us to growth.
Well, that is one of the benefits of tariffs, is this reshoring. And we go back to the average stock. You know, a lot of that reshoring benefits small and mid-cap companies. And so, you know, it is part of the narrative. It does take some time to start showing through in earnings, but as we look at that 2-year forward earnings expectation, that is part of the help, that reshoring of manufacturing.
Katrina, we thank you so much for joining us today, giving some balance to what has been a bit of a bearish market. That is Franklin Templeton's Katrina Dudley. And we're looking at some more movers on our radar this morning. Speaking of the consumer, Five Below is climbing on a strong outlook despite headwinds from tariffs. I am so interested in this because that trade down story should benefit places like Five Below, where maybe you find a charger or a kid toy there instead of maybe going to these more expensive
a kid toy
stores.
is what I'm after.
A toy for your child.
I went to buy, my daughter in the grocery store wanted a balloon. They had these fish-shaped balloons.
Did you tell her that inflation is coming back and it's not possible?
They were $13 for a balloon. I said no. FedEx reports after the bell. You saw FedEx on the board as well. Its shares are down in today's trade. Nike also reporting after the bell, and that could be, as I said earlier, it could be a tough quarter with 11% sales shrinkage there and a turnaround underway. But we will wait to watch Romaine and the close team go through those earnings for you.
Yeah, and coming up, we're going to give you another read on the consumer because Darden Restaurants had missed sales estimates, but the stock is the top gainer in the S&P 500 right now. We're going to take a closer look as to why next. This is Bloomberg Open Interest. And it's time now for our top calls, some of the analyst action that's in focus this morning. First up, the maker of Corona and Modelo beer is no longer a buy at Citigroup. It's downgrading Constellation Brands because of Hispanic consumer weakness and tariff risks. The analyst is also upgrading the maker of Sam Adams beer on growth expectations. Constellation still up, though, 0.8%. Next up, Carvana getting upgraded to a buy at Piper Sandler as it turns bullish on vehicle technology stocks. The analyst says that the sector can grow despite higher tariffs, and the analyst also notes that automakers, except for Tesla, should be avoided. Carvana up 5%. And finally, Southwest Airlines no longer a sell at UBS after some recent strategy changes. The analyst says that the move to charge for bags shows that the company is taking a whatever it takes approach to driving financial improvement. Southwest now up 0.7%, Matt.
All right, another stock that we're watching this morning is Darden Restaurants. After that turnaround in the shares, the owner of Olive Garden says it still expects more than $12 billion in sales this year. But Darden Restaurants, which also owns the Capitol Grill down on Wall Street and the Yard House in Scarsdale, reported mixed third quarter results. If you take a look at the Bloomberg Terminal ECAN function, which we lean on a lot here, you can see retail sales figures from the BLS. This is over the past year. If you click into that yellow box, which is the food and beverage service spending figures, you can see how dire the situation is from the perspective of the U.S. consumer. Here to talk more about eating out is Michael Halen of Bloomberg Intelligence. Michael, let's focus first on Darden specifically. Why do you think the shares are doing so well after the company missed its fiscal third quarter revenue and profit estimates?
Listen, man, they missed by a teeny little bit. Give them a break, Matt. Coming into the number, restaurant stocks have been taking a beating, right? With this down move in the market, there's been a lot of consternation about the consumer sentiment numbers, right? And we take issue with some of those, but everyone expected kind of a softer quarter. Same-store sales are up about 60 basis points. But the real news is that quarter to date, sales are up more than 3% for Darden as an enterprise. And it sounds like, the Olive Garden, Uber Eats initiatives quickly ramping for them. It's making up about 2.5% of sales now at restaurants that have had it for some time. Longhorn continues to outperform, and fine dining did a lot better than expected. So, we're looking forward. The market's looking forward, and that's why the stock's up so much today.
What does it say, this particular company, about where the consumer is right now in terms of what they're willing to pay to eat out?
I think it's a pretty good gauge because they have a wide range of different chains, right? They range from Olive Garden and Cheddar's, which has a pretty significant number of low-income consumers, to the high-end fine dining, Ruth's Chris and Eddie V's and chains like that. So I think that for that reason, it's pretty good. But at the same time, Darden has done a good job of pricing below its competitors since the start of the pandemic by, maybe 600 basis points. And so for that reason, we came into the year expecting Darden to kind of outperform their peers, and they've done so to date.
So you say you take issue with some of the negative consumer sentiment numbers, Michael. We showed that ECAN function and food and beverage services spending seems to have gone down a lot. The consumer across the income spectrum has a lower bank balance than pre-COVID and higher debt than pre-COVID. Do you think we're being too bearish?
I do. I do. We think for a few reasons. I mean, first of all, survey data. If you read the Michigan Sentiment Survey, it's become highly politicized. And then also survey data. People often like to say one thing and do another, or as my friend Alan Hickok at BCG likes to say, people like to talk skinny and eat fat. So it's not, the most important thing we look at. Credit card balances are rising still, but at a much slower pace than a year ago. The delinquency data is a lot better than a year ago. So yeah, I think tariff headlines have scared people, but when you really dig in, some of the CEOs that we've talked to said that the slowdown in January and February was kind of broad-based against all consumer types, right? And that, to us, that says it was more impacted by weather, which Darden credited about 100 basis points of their slowdown to weather, to a very bad flu season, right? Because we know high-income consumer balance sheets aren't worse than they were a year ago. You know, just a month ago, we were seeing all-time highs in crypto, home prices, and the S&P. Obviously, S&P's down, I don't know, 8% or so since then, but still higher than it was a year ago. So consumer balance sheets aren't a whole lot worse. In fact, that we think most of the balance sheets are better than they were a year ago, and that's why we're part of the reason why we're more bullish on restaurant stocks. Also, we're lapping a restaurant recession. Sales were horrible last year.
Michael, I appreciate it. We appreciate you joining us here on Bloomberg Open Interest. And I love your haircut. The whole thing that you've got going on. It's fantastic. Michael Hale.
Man, I save a lot of money on haircuts.
Of Bloomberg Intelligence. In the next hour, we get another read on the consumer with the CEO of Newell Brands, which owns Rubbermaid as well as Elmer's Glue. This is Bloomberg Open Interest. This is Bloomberg Open Interest. Let's get a quick check on what's going on in the stock market. We are just 22 minutes into the session right now, and the losses are not nearly as bad as they were at the open. The S&P 500 now off less than 0.25% at 56.62. The Nasdaq down even less, 19,700. The level on the Nasdaq. Small caps are still taking a beating off 0.5%. But when Katie's not here, who cares about small caps, right?
We care about small caps. We care. We just don't talk about them that much because they're indeed small. But, you know, let's call it a little bit of a give back. It's nothing crazy today after yesterday's surge after the Fed meeting. And we're going to turn now, speaking of giving back, we're going to talk about the strategy session because the S&P 500 will end this year in the 6,500 range, according to a new Bloomberg survey of Wall Street strategists. So that's a little optimistic there. Christina Kino works with the MLive team, joins us now. We are looking at gains for the S&P 500 by and large when you talk to the strategy community, when you talk to investors. So what's going to bring us there?
Well, Sonali, I mean, I guess it's just kind of a flushing out of this negative sentiment that we're seeing in equities right now, right? I mean, we've already seen that 10% correction and kind of a rebound from that this week. So that's helping a little bit. And, you know, we're starting to see sentiment kind of bottoming out here a little bit. The question is kind of how investors are really going to take that Federal Reserve meeting from yesterday, because initially the message was positive for stocks, right? The fact that, oh, okay, they're seeing growth slowing down, but not necessarily a recession, in this whole idea of the tariffs impact being transitory, initially taken as good news. But I think what people are doing this morning is kind of taking a look at the nuances of the Fed's outlook for its rate path. It's not actually as dovish as we thought yesterday, because if you look at the distribution of the rate outlook, that's looking a little bit more hawkish and not usually good news for stocks.
I wonder how important going through the nuance of the Fed press conference is to the markets now. You know, there are times when the Fed is everything, and there are times when I barely notice it unless I'm watching The Fed Decides with John Ferro and Tom Keene. So does it really matter that much to the market that the Fed did exactly what we expected the Fed to do yesterday?
Well, Matt, I mean, I think there are kind of signals to take from the meeting yesterday, but I think you're absolutely right. We're definitely in a world where the Fed is not the only game in town anymore for markets. I mean, that was definitely the case last year prior to Trump's second term. But of course, now we have the new administration. It's going ahead with policies that are very much game changing for the economy and therefore the stock markets. And so, yeah, I think there's a lot of kind of signals for investors to take from what's happening in policy, not just from the Fed, but also from the administration.
Christine, thank you so very much for joining us this morning. Of course, always keeping an eye on what's going on in the investor community.
Check out the MLive blog.
Check out the MLive blog.
MLIV Go on your Bloomberg terminal to watch Christine's work.
Now, I also want to talk about, Matt, with you, something else that's going on in the market. You're not seeing it on the tape yet because it's almost going to get there. It's not quite there yet. CoreWeave right now is doing a roadshow in the middle of this crazy market. I love to see it because finally you're seeing the ability for a company to maybe go public. And we have not been seeing it. You can list ETNs that nobody can pronounce, but you can't list a public company in this market. CoreWeave is backed by NVIDIA, and even though they are finally doing this roadshow, it's scaled back. They're going to be probably around $26 billion at the high end of the marketed range in value. They were trying to go for $35 billion.
Yeah, exactly. Yeah, so that's scaled back quite a bit.
Right.
Interesting. Almost a third of the valuation been lopped off. And you can see why, right? Investors until now have only been putting money towards these big mega cap stocks and not so interested in the smaller ones. That's why we haven't seen a lot of them come to market. Coming up the next hour, Barry Knapp joins us from Ironsides. We also get Prince Constantine of the Netherlands, as well as the CEO of Newell Brands. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Bassett. Katie Greifeld is off today. And coming up, Powell brings back the T word. The Fed chair downplayed tariff risks, saying that the impact on consumer prices may be transitory. And speaking of the consumer, we're going to get insight from the C-suite from the CEO of Newell Brands, the company behind the likes of Rubbermaid, Yankee Candles, Sharpie pens, and more. Plus, NVIDIA is betting big on American-made chips. We're live this hour at NVIDIA's AI conference in San Jose, California.
All right, let's get a check on what's going on in markets. We're now looking at green arrows after a pretty negative open. We were down almost 1% on the S&P and the NASDAQ in the first few minutes of trading. And you can see that we're little changed right now on both of those indexes. The 10-year yield, to me, is really the news in markets today. I mean, we were trading at 430 for the last couple of weeks and looked like it was a new normal until the Fed came out yesterday with no moves on rates as expected, but higher interest rate a higher inflation forecast and a lower growth forecast. The question is whether you see that as hawkish or dovish. Yeah. No matter what, it chopped more than 10 basis points off the 10-year yield.
And even more movement this morning. We got as low as 417. I also want to bring you some breaking news, Matt, because on the heels of that lower 10-year relative to what we saw, of course, mortgage rates have gone down a little bit, and that has led to the data. U.S. February existing home sales rise to 4.26 million. The estimate was under 4 million, so that's good. People are buying. But the median home price had risen 3.8% to $398,400. So prices rising, which you would expect if people are buying more homes. But of course, sales are rising. That is actually very positive sentiment for the economy.
Yeah, absolutely great news for the U.S. economy. We'll continue to cover that for you. Right now, we want to talk about his interpretation of the Fed with Barry Knapp. He joins us, Ironside's macroeconomics director of research and chief market strategist, I'm guessing out of Vail, just looking at the slopes behind him. Barry, what did you take from yesterday's Fed meeting? I mean, there was no move with the exception of the SEP, but it seemed that Jay Powell was kind of walking on eggshells when talking about inflation and actually used the word transitory again.
My main takeaways, the first issue and the real shocker yesterday was the decision to reduce QT from, at least in treasuries, from $25 billion a month to $20 billion a month, or to $5 billion a month, excuse me. Their framework that they previously delineated from people like Roberto Perli down at the New York Fed provided no justification for this cut. There had been some discussion that when the Treasury, the debt ceiling issue is resolved, Treasury needs to issue more bills to build back up their checking account at the Fed, the TJA Powell kept referring to. But none of that really justified a reduction of that much in the way of their monthly runoff of their balance sheet. So, my first reaction to that was, what the heck are you doing? But then as I started to think about it, and they'll never admit to this, and the motivation isn't nearly as important as the implications, but I think that Bessent and Powell may have had a meeting of minds about keeping the most important price in the global capital system, the 10-year Treasury yield, stable while they go through this big, what Bessent described as detox process from the addiction to government spending. I called it cleaning up the industrial policy mess when I wrote about this 4 weeks ago and called for a correction in equities and a rally in treasuries. But that is a very significant technical decision, and it is an easing of policy.
Barry,
there's just no two ways
I'm
about
so
it.
glad you brought this up, and I also want to point out, as we've been speaking, the bulls are back, I guess. I mean, to some degree, you have the S&P 500 now up. It was down on the morning, and you saw that bid into the 10-year come at a significant pace this morning. Is a lot of this technicals? I think one fascinating thing that you're talking about is that the Treasury Department and the Fed seem to be on the same page. How bullish is that?
Well, it's bullish for the back end. There's still this ongoing long-term issue. I've been wildly critical of the Fed through the entire tightening process. They eased mostly through their balance sheet, and they tightened mostly using the policy rate. That caused return on equity in the small banks, the regional banks, Shanali, right up your alley, to collapse all the way down to 5%. Now, when the curve disinverted in the fall, that jumped back up to about 7 3/4, but this is still too low. There's a lot of pressure on small banks, small businesses, floating rate borrowers versus fixed rate borrowers. This doesn't really resolve it, but it does allow for a smoother process as we go through this, this detox process. There's a couple other things I would mention about all this too. One is the way Powell characterized the primary objectives or issues around the changes that the administration is trying to make is he listed it as trade, immigration, fiscal, and regulation. I would have not put it in that order at all. Maybe he didn't mean it to be in order of importance, but I would describe spending as the most important issue to stabilize the Treasury market over time, taxes as the most important issue to try and rebuild capital spending, which has been falling for 2 years, then it's regulatory policy, then it's immigration. The least important is trade. That's the one we're all focused on. But the Fed shouldn't be focused on that. They should be focused on smoothing the cuts in government spending, the potential fallout in the labor market. And, a man I know reasonably well, and you guys had on right after the meeting yesterday, former New York Fed President Dudley said the thing to watch is the unemployment rate. I absolutely think the labor market is very unstable here. Churn has collapsed. Hiring rates have collapsed. The U6 underemployment rate jumped from 7.5 to 8 last month. It's likely we're going to get a very weak report. And I think the Fed could be pivoting to rate cuts as soon as intra-meeting and potentially cutting in May. So big change in Fed policy here on that.
Potentially cutting in May. I can't remember if it was Bob Michael yesterday who said that he expects, if there's not a cut in May, there are not going to be any cuts this year. Is that, you think, the case? And how many cuts do you expect? Because the dot plot showed that at least the median estimate or forecast or whatever you want to call it here is for 2 cuts this year.
I think Bob makes a decent point. I'm not sure I would have gone quite as far as him. As I've been saying, the labor market foundation is really unstable. I reject the idea that last month's report was strong. The work week is at lows. The job finding rates collapse. It's in a very precarious position. We've received a pretty serious business confidence shock right now. And so whether that translates, and we're going to reduce government employment and contractors related to government. So the risks are in the near term. But I think saying if it doesn't happen in May, it won't happen all year, I think is a little extreme. It could be June. But I think they will very likely restart the cutting process. And I expect them to cut a fair bit this year. So,
a little earlier you said that you had been eyeing a correction. You had been calling for it. Barry, do you think it's over?
Well, I expected 10 to 12%, which is typically what you get related to a real deceleration in growth, soft patch growth scare. I don't think we're going into a recession, but we could get close over the next 2 quarters as we cut government spending before capital investment recovers, hopefully in the second half of the year if we can stabilize business confidence. So we've gone down about as much as I thought. I think 10s will probably go to 4% here, but the time frame is a little bit early for us to bottom. So I disagree with those talking about survey measures like, the AAII measure showing extreme bearishness. The volatility markets haven't really shown that. Yeah, we got some disinversion of the VIX curve and the VIX is up, but none of these things really point to an extreme move in positioning that would sustain a rally from this point. So I think it's too early for a sustainable bottom to be in or some sort of V bottom to form. Those are rare anyway. I think it's probably, but when the Fed starts to make the pivot, the market will initially react favorably, but then you're going to get the oh no moment. Maybe the Fed knows something we don't know, and maybe the economy really is headed for a recession. So, I think we're going to flounder for the next couple of months. And then if we can restabilize business confidence and show some evidence, green shoots that capital investment really is going to improve, And my framework for this is, in the fourth quarter, we had a positive 50 basis point contribution from government spending and a negative 50 basis point contribution from capital spending. Software investment, intellectual properties investment had slowed to zero. That is not the long-term trend. So we really had a negative environment, and we really have to improve private sector investment to get the economy on track and get to the other side of the, I keep using the expression because I liked it so much, the detox process.
Barry, we thank you so very much for your time this morning. That is Barry Knapp of Ironsides Macroeconomics. We all are going through a detox, although what did Michael Halen call it? Say you're being healthy,
he
but
says,
eat fat.
Talk thin, eat fat.
Talk thin, eat fat. It's what the market's doing. It's what we're doing.
Yeah, I'm not planning on detoxing at all.
No
actually.
way.
Speak for yourself.
But speaking of privately held companies, we're going to break into the U.S. market. We're going to talk to Prince Constantine of the Netherlands and Mariella Licor Alma of Datamaran, joining us to discuss their efforts to help startups from the Netherlands break into U.S. venture capital. We're going to talk about what it's like to stay private, go public, all of the above. This is Bloomberg Open Interest. Now, Tech Leap is a startup out of the Netherlands that is helping support Dutch technology entrepreneurship here in the United States. And they are in New York this week with a number of Dutch startups to host meetings with top venture capital investors and U.S. unicorns. Joining us now, our Tech Leap special envoy, who is Prince Constantine van Oranje, and Datamaran CEO, co-founder Mariella Licor Alma. And Datamaran is a company deeply integrated into the Dutch tech ecosystem and is hosting meetings, of course, is here in New York and in London and in various locations around the world. Now, let's talk about the vibe you're getting here in New York. It's an interesting time because people are interested in technology. The markets, though, have been shaky. The IPO window is something people have been waiting to see open up again. What are you seeing in your conversations?
Well, exactly that. I think there's a lot of perspective on IPOs. I mean, I think the same in Europe. We're really hoping that this market starts to flow again. There's also some insecurity about where things are going with the tariffs, but I think there's a lot of enthusiasm to still, invest in the U.S., to come to the U.S. to find investors and to build here. It's still, for many of the companies, it's probably their fastest growing market and an important market to be in.
Now, interestingly enough, you have raised money recently, Mariella, for your company, Datamaran. What was that like? Do you think the environment today is like it was just last year, or do you think it has changed meaningfully for other companies that are looking to tap the market?
Yeah, so obviously there's a lot of uncertainty in the market today. And I think what we experienced during the Series C round is that we were dealing with a party that was looking at the market already in a bit more of a selective way. So looking for companies that were prepared to create long-term value, very much looking at our business fundamentals, at the founder composition. And I think that's probably one of the opportunities that we see today, is that there's not a lot of money perhaps flying around to invest in what I would call, bets, right? Placing bets on a lot of companies. But I think the opportunity is for investors to be more selective. And I think also when you look at the Dutch ecosystems, these are typically companies that fly a little bit more under the radar, that might not seek the spotlight immediately, but for that reason might, have very strong business fundamentals because they've been bootstrapping and really making sure they got their value proposition right.
Now, what's interesting also is your company deals with artificial intelligence. The other advantage is it deals with companies that are business-to-business seeking here in the market. What about the companies that you're working with, Prince Constantine? Do you see the need for artificial intelligence to be part of the story? If it's not part of the story, are companies going to have a harder time?
Oh, yeah. No, I think we can see a number of different companies. You've got the AI native companies that are building parts of the AI stack. Those are, of course, in very high demand, and we've seen them all across the world, across Europe as well, I think. But those are the companies we would like to see more of. Then we have a lot of companies that are applying AI, even new companies. And then we have a whole bucket of companies also in our community that are all SaaS companies. And those are all refiguring out their business models and their go-to-market, and I think there's the biggest challenge, because a lot of money has gone into these companies in the past. They were the darlings of VC, and they now have to really adjust really rapidly to become AI native, and there we see the biggest challenge.
It's interesting also, to what extent is a path to IPOing important?
It's critically important, though many companies in Europe and Netherlands would also look at M&A exits. But the IPO, of course, that's the North Star. Yes, the Holy Grail, and that market has been largely inactive, and we hope that this year to see some of them. Of course, the Klarna IPO is one of the bright spots, and we hope that that's going to ignite many more IPOs this year.
How do you feel about this, Mariella? If you think about it, it's interesting. At the very moment, we're watching one company out there look at a roadshow, start a roadshow, but CoreWeave, as it goes public, it looked to be a $35 billion company. It's looking like it might be less than $26 billion in public markets. Are you watching these instances to determine how you might look to IPO one day?
I think at the moment we're very much looking at how can we best serve our customers in a time that there's a lot of volatility, there's a lot of uncertainty. Both, when you think about our business, we're dealing with the omnibus in the European Union, so the Simplification Act on the Corporate Sustainability Reporting Directive, pushing companies to rethink their strategies as to long-term value creation and sustainability, and at the same time, there's developments here in the US as well. So we are very much at a time where we're closely looking at the customer. What does the customer really want, and how do we best reposition and respond to those changing market needs? So we're not as much thinking ahead in terms of like IPO and what's ahead in 3 to 5 years. It's just very difficult to do that right now. We are doubling down on making sure that we are providing the right set of tools, platforms to the customer.
It's a great point. You look here in the United States, and a lot of those efforts surrounding energy sustainability governance have been unwound. They have been taken back in many regards. How do you think about the energy transition, green technology, as you talk to startups? in the Netherlands. Is it something where some of those priorities for international companies have changed meaningfully, or do you see there are places where this is still a huge priority?
No, it's definitely a huge priority. The underlying logic is still the same. We need to be less dependent on fuels, and we're seeing this. I think there's more inconsistencies in the support policies. So many of our solar companies having big troubles at the moment. And then there is some of our circular plastics companies are having problems because the price of plastic from China is just so low. And if policymakers then don't step in and create a market, then for those companies it's going to be very difficult. So we do see in very specific niches we see issues, but on the whole the fundamentals around energy transition, less dependency, bigger diversity, diversifying the energy mix, I think that's still the same, and we've seen a lot of companies entering in this space.
We thank you both for joining us here on set in your visit to New York City. Of course, a very important time to be talking to the venture capital community. That is Constantine Van Oranje of TechLeap and Mariella Lecor Alma of Datamaran. Now let's get a check on markets here, because of course it's been a choppy trade this morning, and we had seen the S&P 500 flip into the green. Looks like it's staying there. It's up about 0.3%. The Nasdaq 100 up 0.4%. This of course comes off the back of a rally we saw on the heels of the Fed decision yesterday. Looks like investors still have confidence here. That 10-year yield now back up to 4.2%. We saw it jump a little bit below just really about a half an hour ago, but now has flipped higher on yields, which is actually not so bad if you're not too worried about growth, even though the Fed says it will be impacted. We'll bring you more markets ahead. Stick with us. This is Bloomberg Open Interest.
Let's get a look now at high interest, what's making headlines around the world. Nike has lost 44% of its value over the past 3 years, and we may get another reminder of why this afternoon. The Beaverton, Oregon-based shoemaker will post fiscal third quarter earnings after the bell, and analysts project quarterly sales sank 11%. which would be the biggest drop since the depths of COVID. The CEO, Elliott Hill, who took over in October, has been clearing out the ranks. The departures of the Chief Strategy and Transformation Officer, as well as the Chief Communications Officer, were announced yesterday in an internal memo. FedEx is expected to cut its annual outlook or guide to the lower end of the current range when the company reports third quarter earnings after the bell today. Some of those challenges the company faces include tariff uncertainty, weak consumer demand, and lower manufacturing activity. The company lowered its adjusted earnings per share outlook last quarter. And U.S. listed shares of PDD are down in the early trade this morning. The parent company of Temu missed sales estimates last quarter, notching a third miss in a row. The Chinese budget shopping site's results indicate heightened financial risk posed by U.S. tariffs on China to Temu's growing global business. Let's get a quick check on what's going on in the markets. About an hour into the trade now, we do see green arrows across the board here, and we're climbing to session highs. The S&P 500 up 0.5%, the NASDAQ 100 up more than that, and the U.S. 10-year yield holding now right at 4.20, down about 10 basis points from where we saw it at this time yesterday, and 4 below the close of trading. So it does look like the Fed pause is being read now as dovish. Of course, the Fed also raised its inflation outlook for the year and lowered its growth forecast, but the dot plot still has, at least at the median, 2 cuts factored in for 2025. Coming up, Newell Brands joins us. They say they're in a better position than others when it comes to tariffs. Christopher Peterson, the CEO and president, explains next. This is Bloomberg. This is Open Interest. Newell Brands says it is preparing for tariffs, and it has been for some time. The company behind brands like Rubbermaid, Yankee Candle, and Elmer's Glue has been shifting production out of China for the last few years. Chris Peterson, the president and CEO of Newell Brands, says this leaves his company better positioned to navigate upcoming tariff headwinds. And Chris joins us on Open Interest now. Chris, thanks so much for your time. Let me first ask about your supply chain. You know, how much of it was in China, and outside the U.S. previously, and how much are you producing here in America now?
Yeah. Great to be with you. So about 60% of our business is sold in the U.S., 40% is sold outside the U.S. The majority of our U.S. business is manufactured in the U.S. We have 15 manufacturing plants in the U.S. That are Newell manufacturing plants producing products here. Outside the U.S., the biggest country that we were sourcing from previously was China. It represented at its peak several years ago about 30% of our global cost of goods sold. Today, that number is down close to 15%, and by the end of this year, it should be down to about 10%. So we are exposed in some of our product categories to China imports, but the majority of our U.S. business is made in the USA, and we believe that's a big advantage for us.
You know, in addition to the questions around China, more importantly, perhaps because of the uncertainty and the near-term uncertainty, is also Mexico. You recently told investors that roughly 5% of your cost of goods sold were from Mexico. And so what kind of uncertainty do you see among the North American agreements that are in place, and how investors should be thinking about how you move forward in the middle of that uncertainty, or how you navigate it?
Yeah, it's a very dynamic environment. We obviously are paying very close attention to the trade and tariff policy coming out of the administration. We have 2 manufacturing plants in Mexico. One is a blender plant that largely supplies Latin America, that would not be subject to U.S. tariffs, but they have a small amount of business that comes from that blender plant into the U.S. that would be subject to tariffs. We also have a small volume writing plant in Mexicali. Our biggest writing plant with the high velocity items is in Maryville, Tennessee. And so we have flexibility to move manufacturing a little bit over time. And we are evaluating the situation, and I think we are well positioned to respond dynamically.
Chris, as somebody who's made the changes earlier on to bring more manufacturing onshore, to make sure that reliance is not entirely on China, what can you tell other CEOs? What do you tell investors about that process? Has it been enormously expensive? Does it mean that you've had to stomach higher costs of production? What should people know?
Yeah, I think a couple of things. So first of all, since the 2017 Tax Cut and Jobs Act, we've invested close to $2 billion in U.S. manufacturing as a company. So we have invested in our U.S. manufacturing plants. And importantly, we've invested in automating our manufacturing plants so that today our 15 manufacturing plants are highly automated, and we believe they are cost competitive on a fair trade basis with any plants that are producing these products anywhere in the world. So we think the U.S. can be a great place to build manufacturing plants, to be cost competitive, and to supply the U.S. market.
I'm looking at your stock, Chris, and I always take a look at company stock over 5 years. It's just a sort of default setting with the comp function on the Bloomberg, and I think it's a pretty fair representation of what's going on. It's down 42%. What are investors not understanding about this story, or why have they sold off this stock?
Yeah, so I became the CEO in May of 2023. And when I became the CEO, I looked at that same chart and I declared the company a turnaround. And we went through a very diligent process to look at the capabilities that were required to win in this industry. That led us to coming out with a new strategy, which we publicly announced in June of 2023. We've been implementing and operating against that new strategy now for close to 2 years. And and the strategy is working. So if you look at our results in 2024, for example, we improved our rate of core sales growth on every single business. We grew our gross margin in 2024 by 460 basis points. We significantly generated cash flow and delevered the balance sheet, but there's still more work to do. I think more recently, the stock has taken a little bit of a downturn because people are worried about our ability to navigate the trade and tariff dynamic. I believe there's going to be opportunities for us to be beneficiaries in our U.S. manufactured goods, and and of course we're going to respond appropriately to the goods that we are sourcing from outside the U.S.
Chris,
so
there's one of your products actually that has been playing a very key role. The president has been using a Sharpie to sign those executive orders. It has really taken on a personality of its own, this black Sharpie. So have people been buying more Sharpies? I'm wondering if that's had any impact on the notice of the brand.
Yes, Sharpie is one of our largest brands. It's a great brand. We returned the brand to growth, and so Sharpie has been growing the last couple of years. It, of course, is known for being a permanent marker, and it has a dominant market share. It's all made in Tennessee, and we've extended the brand into gel pens and most recently into creative markers. And so we think Sharpie is a beloved brand that has significant growth opportunity as we better understand consumer needs and innovate with new products that delight consumers.
All right. Very cool.
Very interesting. Chris, we thank you so very much. We'll be keeping an eye out on Newell Brands. That is Chris Peterson, the CEO of Newell. Now, we got breaking news about 30 minutes ago. It really caught my eye. I think it caught Matt's too. A group led by William Chisholm and backed by private equity fund Sixth Street has reached an agreement to buy the Boston Celtics for $6.1 billion. It is the most expensive sale of any North American sports team. We're going to bring in our own Bloomberg's Randall Williams to talk more about what's going on. That is quite the price tag.
Yeah.
And, you know, one thing that struck me about this was Sixth Street's involvement, too. You finally have much more private equity interest in these teams. You have to wonder how much it's driving up the prices because there's more money to back these deals.
For sure. And we reported earlier this week that Sixth Street was already an investor in the San Francisco Giants. Now they doubled down with the Celtics. They're very, very active in sports. They also have NFL approval, and they've put up north of $1 billion to help buy the Celtics.
So Shonali is like watching sports all the time because she bets money on these events.
She's a FanDuel girl?
I can't argue.
I haven't really watched basketball since Larry Bird was wearing the uniform.
Long time.
How are they doing?
The Celtics?
Yeah.
They're one of the leading teams in the NBA's Eastern Conference. They won the title last year. They could be competing for another title this year, and I think people expect them to go far in the playoffs.
Well, what about this deal itself? Why William Chisholm? Who is he?
He is the CEO or founder of Symphony Tech, and he has a group that's backed by Rob Hale and other investors. The exact details of his consortium outside of Sixth Street, Rob Hale, and there's another person who I'm forgetting the name of, we don't know just yet.
In terms of, deals, we've seen, obviously, private equity start to come in and buy NFL teams they're allowed to have stakes in now, right? There's been a lot of movement. Is that going to continue? I mean, we watch M&A on the street, right? But what about in sports?
I think so. You're going to continue to see private equity get into sports franchises, but it's really going to depend on what they'd like to invest in. Now, the Celtics are an iconic franchise that we see succeed all the time. I mean, we're talking about a championship last season. When you're thinking about the NFL, for example, when Aries bought into the Dolphins, that deal included the Hard Rock Stadium. It included the Formula One Miami Grand Prix. It also included the Miami Open. So it really depends on what a institutional investor is looking for, and Sixth Street has found what they're looking for twice in 1 week.
Yeah, it's interesting because, twice in 1 week, it's striking me. To your point on private equity here, you can't see that many deals in normal course of business, but club deals, barbarians at the gate style club deals are coming back in sports. You know, the Dolphins deal was just a couple months ago. What do you think is next in terms of the next big prize asset in sports that you're keeping an eye on?
Well, I think it's to be determined. There are some NFL teams that have clauses where, when an owner passes away or dies, that, they'll go up for sale. But that could be 10 years. It could be 5 years. We just don't know. Well, as far as the Celtics, they have to go to the Board of Governors and get approval. That's a pretty standard process. But, the NBA's governors will meet sometime soon, and they'll look at this. And I think that a lot of NBA investors and people who are interested in NBA expansion will be like, okay, this sets the mark for what we do and don't want to pay. Do we want to pay $6 billion for a potential 31st and 32nd team in the NBA, or do we want to pay less?
After this, I'm going to go watch March Madness. And,
Have you filled out your bracket?
No,
it starts in like 30 minutes.
I know. I didn't fill out a bracket.
I think you're not allowed to fill it out anymore.
No, you're not. It's done.
No. You can now. You have like 30 more minutes to fill out your bracket. BRKT go.
Bracket.
Randall, awesome reporting. We have to have you back on. Randall Williams there talking to us about a $6.1 billion sale of the Boston Celtics. Coming up, we're going to head to San Jose and the NVIDIA GTC AI conference, where it is apparently Quantum Day. I guess that means something. This is Bloomberg Open Interest. It is Quantum Day at the NVIDIA GTC AI conference. It's already been an eventful week for one of the most important stocks in the world. We head to San Jose now, where we are joined by one of the greatest reporters in the world, Bloomberg Technologies, Ed Ludlow. Ed, it's fantastic to see you, and I'm sure you're having a great time at this massive conference. First off, I have to ask you about the $500 billion FT story. That seems like a lot of money, and I didn't know NVIDIA would be spending that amount over the next 4 years globally. How much of that is going to be here in the U.S.?
Yeah, I mean, it's a significant headline, but it's important to clarify that it's not CapEx. The way to think about it is that NVIDIA's data center business, in other words, the business of putting infrastructure in place for AI, is already well beyond $100 billion annually, the bulk of which is in the United States. It's a segment that's estimated to grow 20% annually from here on in, give or take. And so what Jensen Huang's talked about a number of times, actually, in the last 2 days, is the idea that they've increasingly shifted their supply chain onshore in the United States. TSMC in Arizona, as it ramps up, they will commit more of the manufacturing of the key GPUs or AI accelerators to what's available. But you know, by virtue, it's the cost of doing business essentially. If you have 70% market share of what is 100 billion alone for that company, inevitably over the next 4 to 5 years, they'll be spending similar to get those data center either refreshed with latest generation hardware or put new hardware in from the start.
Ed, as much as I want to ask you about quantum computing, I am very interested in it. I actually want to know first what you feel about the denial that Jensen Huang had in that story about any consortium around Intel.
Right, we are having Quantum Day today because of what happened at CES in January. During an analyst Q&A, Jensen Huang was asked, what do you think about quantum? He said, with his genuine belief, that quantum computers were more than a decade away from doing anything useful. NVIDIA already supplies the quantum industry. It does not make quantum computers itself, but what they do is provide their own AI supercomputers. Those AI supercomputers are simply used to calibrate and reduce error count on quantum computing. They are two completely distinct fields, but of course at the time you saw those quantum stocks go into free fall. That is the weight that Jensen Huang carries. Today there will be several thousand people in a room where Jensen Huang will speak to the CEOs of those quantum companies and try and find some middle ground. But let's be absolutely clear, NVIDIA does not make quantum computers. It sells its existing technology, the GPUs that it manufactures for training and inference on AI models, to help those quantum computers make their own technology better. It's as simple as that, though I'm really curious if the reaction today to what Jensen says is as severe in either direction to what happened in January. That's the simple fact of it.
Ed, I'm sure you've been watching, as we all have, this drawdown in the Magnificent Seven stocks, which, you know, the majority of them you cover very closely. I guess all of them you cover very closely on Bloomberg Technology, which you co-anchor with Caroline Hyde. What's your thought on the broader market going away from these mega cap stocks that supplied the bulk of the gains we've seen on the index level over the past couple of years?
There's the macro level effect, of which I'm no expert, right? But all of those stocks have had that decline since President Trump's inauguration. And that's the sort of post in time that we're marking it by. There is an element, particularly as it relates to NVIDIA, about how much you believe the sustainability of all of the hyperscalers, the cloud computing companies, investing in new data centers. It touches all of those companies in some way, including Tesla to a certain extent, because they also rely on NVIDIA hardware as well as others. And this was what's so interesting about Jensen Huang yesterday. He was super frustrated because he basically said, I've done something that no company's ever done before, particularly a technology company. I've told you what I'm going to do for the next 4 years. So why is it that you don't believe me? He gave the analogy of a Louis Vuitton handbag. When does Louis Vuitton ever release its 2025 handbag and say, by the way, here's my handbags for 26, 27, and 28? That doesn't happen. And Jensen's argument is, why is the market not seeing I've told you what happens in the next 4 years, and we're a foundational company in this space. All of the other technology companies will follow suit. That's the argument he made. The stock's up 1.7% today, but I mean, it is a point in time. It's been choppy all week, and I think there's still a lot of disbelief of the staying power, particularly in a recessionary environment. And again, when it comes to economics and macro, I'm no expert. I just like boxes, gadgets, and electronics.
And handbags. Ed Ludlow, we thank you so very much for your time. We can't wait to hear from you, because this afternoon at 4:30 p.m., there's going to be a special edition of Bloomberg Technology live from the NVIDIA GTC AI conference in San Jose. And coming up, we're going to have an inside look. We're going to switch gears, talk about banking, because Citigroup's private equity club has flopped, and it's left a lot of billionaires disappointed in its wake. That's next in the Wall Street Beat. This is Bloomberg.
This is Bloomberg Open Interest, looking at gains right now in terms of the major indexes. You can see the S&P 500 currently up 0.5, about 0.5%. The NASDAQ 100 up 0.6%. And the 10-year yield still down 3 basis points, but at 4.21. It's not as weak as it was when we first started this show about 2 hours ago. We're looking at 4.17. So
yeah, it's interesting.
A little ground back.
Fascinating to see yields higher, but it's less bearish because you're not as worried about growth. Funny market, a little upside down. And, you know, we woke up on the wrong side of the bed, but we are back in the green. So we are going to turn now for a minute. Well, things are calm. We're going to turn to the Wall Street Beat. Today, we're going to look at Citi's private equity club that was launched in 2012 with Silverfern. And it was designed to offer exclusive investment opportunities to wealthy clients. But instead, it created unhappy billionaires, legal battles, and a hard lesson on the pitfalls of marketing private assets. Bloomberg's Todd Gillespie has the story. Pretty fascinating. I mean, the wealth business, of course, was very near and dear, is very near and dear to Citigroup. Private equity is a huge part, private credit, huge part of that story for wealthy clients. What went wrong with this initiative?
Totally. Well, you know, you go back in time, Shonali, it all looked rosy at the time. You know, big banks were looking to offer these new types of, alternative investments to their clients. They didn't have access to these kinds of markets themselves. We're talking 2012 when this initiative started. And it looked like they could partner with this intermediary, Silverfern. These people came along with a great idea. Looked like great. Citi and Silverfern can cut the fees. Everybody wins. But what happens when deals don't turn out? What happens when the products that you're actually marketing your clients aren't very good?
Yeah, people get angry, obviously, and as we point out, I guess in the headline, that these are billionaire members who were angry. When me and Sonali get mad at you, it's no big deal. If a billionaire gets mad at you, it becomes a problem, right? And they bring
depends on how loud you scream, I guess.
and they bring lawsuits, right?
No, I have nightmares about you getting mad at me, guys, on TV. Yeah, exactly. Right. I mean, what happened really, Silverfern were quite frustrated that they weren't getting the traction with Citi's clients, right? They thought in some way Citi had some kind of responsibility. They claimed that Citi had some kind of responsibility to market, to make sure that their clients were actually putting in the money to these deals. There's one quite amusing correspondence in the story where Clive Holmes, one of the founders of Silverfern, along with his wife Rita, complains that a billionaire client of Citi's, who is worth 4 times George Soros, invests only $500,000 into one investment. And Clive says, "Oh, this is, my car costs more than that." So, I don't know how much your car costs, Matt, but more than $500,000 is,
That's a very expensive car. I don't have, to be clear, any cars that come near to that mark.
Well, yeah, just to be clear, right, I mean, this litigation finally ended in February, more than a decade after this program started, years still after things started to sour. But it really is an interesting step-by-step showcase of what can go wrong.
Real quickly here, Todd, is there reputational damage that Citi had suffered because of this initiative? That's, I think, what people were really watching. Can they keep these billionaire clients happy as they go through this transformation?
Yeah, I mean, it's a good question. And I mean, you see in the story that one of their Latin America, the person who now runs most of their Latin America investment counseling services, she says, take a look at the clients who were part of this club at the time. None of them are doing private equity with Citi anymore. But that's also, just to bear in mind, not necessarily Citi's fault, partly Silverfern's fault maybe for putting these clients off as well. But, it's also a responsibility of the fact that private equity companies are building out their own wealth divisions, going straight to the source, going straight to these big clients with their own wealth teams, their own relationship managers, and don't need these banks anymore.
Super interesting dynamic. Yeah. Todd, we thank you so much for your time. That is Bloomberg's Todd Gillespie. Of course, one of the most read stories on the terminal this morning. Yeah, and by the way, we are going to talk about cars that cost more than $500,000. Next week, at this time, we're going to have Singer on. Very excited. Rob Dickinson from Singer, the company that makes backdated Porsche 964s. Coming up tomorrow, though, on Open Interest, we have a fantastic lineup of guests as well, including Electro Harmonix founder Mike Matthews. You may know his Big Muffs guitar pedal used by the likes of Jimi Hendrix and Nirvana. Vijay Rakesh joins us from Mizuho, and Ann Berry of Threadneedle. This is Bloomberg.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from San Francisco, I'm Tim Stenovec, and this is Bloomberg Technology. Coming up, today is Quantum Day at NVIDIA GTC, and Ed Ludlow is there. We'll have the main takeaways from the conference so far and discuss what to expect from today. Plus, SoftBank is acquiring the chip designer Ampere in an all-cash transaction valued at $6.5 billion. We'll sit down with Ampere's CEO to learn more about the deal. And Campus, a for-profit community college, has raised $46 million from investors, including Sam Altman, Peter Thiel's Founder Fund, and Joe Lonsdale's 8VC. The founder and Joe Lonsdale join us on the future of EdTech. First, though, a check of the markets, and we're seeing some green across the screen. Stocks opening higher after yesterday's Fed-fueled rally, or I should say lower, but then it was the best Fed day going back to July. Then about a half hour into the trading session, we got some surprisingly strong housing data, which turned around the trade. At last check, about 65 stocks in the NASDAQ 100 moving higher. Right now, up about 0.4%, off its best levels of the day so far, but still in the green. One of the stocks that's helping to push the NASDAQ 100 higher is Meta Platforms. Investors cheering the news that Meta will roll out Meta AI across 41 European countries this week. It's up right now by about 4%. Meta's intelligent chat function will also be rolled out across 21 overseas territories and available in 6 European languages, the company said in a statement. It's going to be free, too, across its apps, including Facebook, Instagram, WhatsApp, and Messenger. Also watching shares of Intel, down about 0.7%. It did fall by nearly 7% yesterday after a TSMC board member dismissed a report that the company has pitched to major U.S. chip makers about taking stakes in a JV to operate Intel's factories. Shares were bouncing back earlier, but lower now. And NVIDIA is higher today as the company continues its GTC AI conference in San Jose. Today, of course, Quantum Day. NVIDIA shares higher by 1.3%. And that's exactly where we go now, live from the GTC event. Our own Ed Ludlow joining us. Ed, I want you to set the scene for us, but I also want you to clear something up for us because there's lots of chatter this morning about NVIDIA in the context of money being spent in the U.S. What's going on?
Yeah, it's based on an interview that Jensen Huang, the CEO, gave the Financial Times. And what he's quoted as saying is that NVIDIA will procure $500 billion worth of electronics in the next 4 or 5 years. But what he's not saying is that that is capital expenditures, right? This is a company that has 70% market share in the market for AI accelerators, high-performance GPUs that go into data centers. He spent a lot of time yesterday. We were with him for an hour explaining the mechanics of that, right? When you build a data center from scratch or you upgrade its technology, that is a tens of billions of dollars or hundreds of billions of dollars project. If you have 70% market share for the brain that goes into it, inevitably you're going to have to pay TSMC to manufacture the chips. You're going to work with Dell and HPE on the server rack assembly and packaging. That's what he's referencing, essentially, the cost of doing business. And it's interesting because this is what Jensen Huang wants us to be talking about. He sees NVIDIA as foundational to all AI companies. In other words, companies are being created because of what NVIDIA is doing in the context of it calling itself an AI infrastructure company, an AI factory company.
Okay, AI infrastructure and AI factory. Today, though, is Quantum Day. And NVIDIA doesn't actually make quantum computers. What's going on?
Correct. Yeah, so exactly the same point as with AI data centers. NVIDIA does not make quantum computers. What it does is sell its existing technology to the quantum computing industry to help them make their own machines better. You can use an AI supercomputer for error correction and calibration of a quantum computer, but they're essentially two distinct fields. Of course, quantum computers follow quantum mechanics and are coded in qubits, not in bits, ones and zeros. But we're all here today because of what happened in January, right? Jensen Huang was asked, basically at point blank, what do you think of quantum computers. And he said they're more than a decade away from being useful. The net result that day, January 8th, was that the publicly traded quantum computing stocks all sank 30, 40%. And so we're all assembling today, and Jensen's going to be on stage with all of the quantum computing CEOs who are basically his customers. He just sells the existing gear to them. And maybe we'll get an update on how Jensen feels on quantum computing. But from NVIDIA's perspective, it's an arm of research, and it's where they sell existing tech, GPUs principally, to that industry. They do not make quantum computers.
Bloomberg's Ed Ludlow. Ed at NVIDIA GTC. Ed, good to see you. We'll see you a little later, too. Thanks so much. Stay with us, though, because Bloomberg this afternoon has a special edition of Bloomberg Technology on quantum computing. Ed Ludlow will return live from NVIDIA's GTC event starting at 4:30 p.m. Eastern Time. For more on the broader tech market and NVIDIA, let's bring in Sylvia Jablonski, Defiance ETF's CEO. She joins us now. Sylvia, I'm wondering how you're watching everything happening at NVIDIA GTC. You do argue that NVIDIA is a buy right now off of its highs. How are you watching everything come out of San Jose this week?
Yes, good morning, and thanks for having me here. I think it's all very exciting. You know, what we've been seeing over the last year or two is just, you know, so much news around the growth of AI, the potential for quantum computing, the build out of 6G, and, you know, who's the star of that show? It's NVIDIA, and you're talking about a stock that, you know, was trading up over above 140 pretty recently before this pullback that we see here at these levels. I mean, I love the stock, I love the company. You're talking about potentially, you know, a fourth industrial revolution, compounded annual growth rate themes of AI and quantum and things like this of 35 to 40% per year. As an investor, I'm patient with technology. It takes time for things to play out, but I want to get in early. And this is still, you know, first innings. A lot of people are saying that, but, you know, we're seeing that it's true as we get more news from this conference.
So do you think that NVIDIA investors right now have it wrong? Does the market have it wrong? To what extent do you think this stock is undervalued right now?
Well, we can always say that the market is, you know, the market's a little bit emotional, right? So I think that there are a lot of reactions in the market, and when the market becomes emotional and people panic, usually they sell the Mag 7 or they sell kind of like the high-flying names that have done well for that year. We've seen it happen with Tesla. We saw it happen with Apple during COVID, you know, all these different sorts of things. And NVIDIA is kind of the poster child of the market this year. So when we have fear and panics about tariffs and things like this, people tend to run for the hills and sell, you know, the most profitable stock. So I just think that there's a lot of liquidity on the sidelines. There's still this consumer sentiment that is uneasy, but eventually, you know, when some of the tariff things shake out and then we get, you know, the tailwinds of lower regulation and tax policy, things that are favorable to the market, these are the names that also rally first, right? So it's kind of like the buy the dips and, you know, sell the rips or hold on to the rip scenario here.
Well, we're still down on the NASDAQ 100, 10%, so officially in correction territory. You said when we get the regulatory clarity, when we get tax cuts, when the tariff stuff shakes out. How are you so certain that stuff is going to shake out?
Well, I think, you know, all of these things take time, right? And the only information we have is the information that we actually get from Washington. And that information seems to be that, you know, the tariff policy is enacted because of these fentanyl issues, immigration issues, cybersecurity, these other types of things that have to be sorted out. We have information that the president plans to, you know, cut taxes to support deregulation of businesses. So I think, to your point, it's a fair question, right? We actually have to see these things pan out. But even if nothing else happens, right, you have an economy that is still growing, positive GDP. It's a little bit lower, but we're still above that 2% range. Jobs are fine. Wages are fine. Corporate earnings are estimated to be in the high single digits, you know, even up to 10% by some analyst estimates. The earnings season was very good. There are still strong balance sheets. And, you know, what we're hearing out of corporate America is that it's, you know, there's still CapEx, right? I don't see a recession either way. So maybe you don't get hyperbolic growth, but when you have these themes like quantum computing and AI that are on sale, I think it's worth potentially taking a risk for long-term returns, regardless of what happens in the next year or so with policy.
Hey, Sylvia, before we let you go, just 20 seconds on Broadcom, another stock you're bullish on, but down 20% from all-time highs.
Yeah, I mean, I think Broadcom is going to be one of the leaders in AI. NVIDIA is the poster child there, but Broadcom should be a second winner.